Hello everyone, and welcome to the very first episode of Easy Cap Raise. And in this episode, we will answer this question. Will VC dry powder hurt early stage startup fundraising? Now, first things first, what is dry powder? Well, in its literal form, dry powder was the reserved gunpowder in the 17th century when battles were fought with cannons. So, in order for the gunpowder to remain effective, it should be kept dry. Okay, so what is the relation with VCs here? As you already know, VCs usually do not have billions of money in and of themselves. Rather, they go to others, generally called LPs, and ask them for money. Each LP gives them a sum of money which becomes millions or in some cases billions in aggregate. When LPs commit to giving money to VCs based on the contracts they sign, the VC essentially has the money but is not using it until it calls the money. Normally, VCs won't call this money unless they have found a promising startup company to invest in. Alright, now that we have a general understanding of what dry powder is, it is good to examine where exactly this money is used and to achieve what aims. As mentioned earlier, one use case of dry powder is for VCs to invest in promising startups. Another use case could be for private equity firms to buy struggling companies. Also, enterprises with access to dry powder may as well use this liquid reserve for add-on purchases. So, up to now, we know what dry powder is, where it is most likely to be used, and what kinds of companies have access to it. Let's dive into the numbers. In 2020, dry powder levels in VC and private equity firms reached $1.5 trillion. This was an all-time high. We all know what scarcity does to people and businesses, but can you believe the abundance of cash, or in other words, dry powder in VCs, who cannot invest in any startup due to hesitation or market volatility, is even worse? But why? Shouldn't having more money to spare mean more startups being funded? The honest answer is no. In fact, it is the other way around. Let's go through basic economics. When the supply rises without much rise in the demand side, the prices go up. In this case, supply is the money given to the demand side, which is the startups, and the price is the valuation of those companies. So, what happens? When the valuation soars, VCs should propose more money to the startups to stay competitive. However, the startup's return for the VC is usually peanuts because of so many business and market factors which are out of the scope of this episode. So, a VC puts loads of money and in return it gets essentially nothing. Wait, what? This is all the reason why after frantic investments of 2021, VCs and private equities have decided to slow down. Think about what they are doing and not call the committed money by LPs to invest in startups. Basically, they're waiting for the valuations to come down and the inflation and interest rates to alleviate. To see what happens for startups in the coming year, there are two opposing views we will discuss here. One is that the $290 billion dry powder committed to the VCs in 2022 will free itself in 2023 by being invested in startups. However, given that this cash is not coming from nowhere and it is in fact coming from retirement funds, financial institutions, trust funds, and wealth management companies, the expectations of LPs should be met by VCs. And it is not really hard to guess the expectation: the cash return. So the $1 million question is where this dry powder will be spent in the next year. Naturally, VCs cannot hold it forever and have to invest it somewhere. But where? Some experts believe this dry powder will be spent on the promising companies already in the VC's portfolio. The established business model and the potential to go to the stock market in a few years are some indicating factors for VCs to choose in which startup to invest from their portfolio. How about the pre-seed and seed fundraising then? The second view discusses that as pre-seed and seed companies are many years from the public market and as the amount needed to be invested in them is usually not of too much concern, pre-seed and seed fundraising will continue to be as strong as before. However, VCs might be pickier and demand better traction before committing. Series A and B entrepreneurs, however, are the ones to be expected to suffer more. Many startups that have made substantial progress but still have unsolved issues about their product market fit, go-to-market strategy, or total addressable market size may find it challenging to raise their next round. All in all, startups will be funded in the next year if they make a great product with fascinating traction. Now, if you want to read more about dry powder and what substitutes LPs have to invest in, visit our website www.easycapraise.com. We are here to help pre-seed all the way to Series B companies in their fundraising rounds. Don't hesitate to contact us if you need any help. And don't forget to hit the subscribe button and the bell to be notified as soon as our next episode is released. Stay safe, bye for now!